Hey y'all, it's Kristen. Welcome to the Tribe Podcast. Tribe is a resource podcast for entrepreneurs looking to build their entrepreneurial tribe. Over my years of working with business owners, I've realized that it's important to know who you need as a part of your network before you need them. Listen in as I ask my trusted resources the question you've always wanted answers to, but didn't want to pay to get. If you're new to your business or you're established and you're just busy, feel free to borrow my tribe as you build your empire. Remember that time you were an entrepreneur and you tried to qualify to buy a house? Yeah, me too. Or are you thinking about it or just thinking about real estate in general and trying to figure out what to do or what kind of position you need to be in to make that happen? Or have you heard that it's impossible? Like, what have you heard about it? Wade Betz is here from Guardian Mortgage. We're going to get into it. Hi, Wade. Thank you for joining us today on the show.
Thank you, Kristen. It's good to be here. Appreciate
Awesome.
you having me.
Of course. So I'm excited to share one of my favorite resources with our tribe here. Wade, can you tell us a little bit about yourself and your business and what you do?
Yeah, no problem. So I am born and raised in New Orleans, came to Dallas area to go to SMU for college. I met my wife there. Now we have two little boys, and life's a big, noisy mess right now. But that's personally, professionally. I've been with my current company for about 13 years now. I'm the leader of the Betz team here at Guardian Mortgage. Throughout that time, I've helped almost 2,500 families and originated about $500 million worth of loans in my career so far.
Jeez. We're going to talk later maybe about the fact that Wade tracks everything. So that's all he knows that. So tell us, how did you get into the mortgage industry?
So when I was in college, I got my degree in economics, and I knew that I also wanted to be in the real estate industry. But that's a pretty broad field. So when you're fresh out of college, and I graduated in '02, so the Y2K thing, .com bubble, everything just kind of blew up in my face right before graduation. And getting a job was pretty hard. So I wasn't picky. I was looking for something in the real estate field. So I looked at everything from property management to title to commercial, developer, you name it in real estate, I looked at it. And the long and short of it is, at one point, my wife went to an event without me. She was my girlfriend at the time, and met somebody that was in the industry. And she mentioned that I wanted to get in the industry. And then it was an 11-month saga of following that lead to the next person, to the next person. And finally, I ended up chatting with a person who had just closed on a refinance with my still boss to this day. And that person mentioned that they were looking to hire green talent and train them up from the ground up. And so that's how I ended up at my company. And it literally took about 11 months to follow that first introduction all the way through hire date. So persistence pays off. And I didn't realize how good I had it here until I'd been here for a while. And it's one of the major reasons I've been here 13 years, where the common trend in my industry, at least, is that 40% of my peers change companies each year. So to have 13 years in one place is very unusual. And it's a testament to how strong our company is.
Yeah. Why would you change every year? That seems like a lot. Like, hard to build relationships and...
You have no idea. I don't know, because it is. You get in these relationships and then you're changing every year or every other year, and you'll start losing trust. You can do that maybe once or twice, but you have people that perpetually change jobs, and it just screams of commitment issues.
Right, right. So you've been doing this for 13 years now. I'm just thinking about this now, and maybe I'll have to bring you on and talk about this another time, but you are like a pro at building relationships and networking and just all things systems around businesses as well. So we're going to put a pin in that for the moment. I think what we really want to hear about today, though, is a lot of people listening to this episode own a business. Maybe they have for a few years, but they may have bought a house like right before they started their business and are thinking about buying another one. Or they started a business not like when they were young and they just didn't think real estate wasn't on their mind. what are some things they should be thinking about either in preparing to purchase a home, or what sort of qualities should they be looking for in someone to help them through the mortgage process?
That's an excellent question, because the days of easy loans are long since gone. After the financial crisis, the government came in and said everyone has to have, quote unquote, the ability to repay your loan, and they purely define that as your debt to income ratio. So if you have a salary job, it's very easy to see your income, whereas if you're self-employed, most self-employed individuals shield as much of their income as they can because it makes great tax planning sense. However, it makes it very difficult to actually qualify for a mortgage. So the best practices for self-employed individual are to plan ahead. So I know that's kind of cliche, but the reality is when lenders are looking at the tax returns of self-employed individuals, we're looking for a 2-year history. And so if income is increasing year over year, we're allowed to take a 24-month average. So that it makes it very easy when it's increasing income. If it's declining income, a lender has to use the most recent year's tax returns, and you don't average it. So what I mean by giving you that information is that if you're intentionally shielding your income in the years preceding when you're looking to actually buy a home or qualify for a mortgage, you're going to put yourself at a disadvantage when it comes time to actually apply. Mm-hmm. So I would have conversations with your CPA well in advance of when you think you're going to move, because they will want to plan accordingly with your taxes, because you don't want to have a situation where you have several years of, let's call it, highly shielded income, and then suddenly you have a big spike in income, and that's going to throw a red flag to the IRS. So right. I'm not a CPA, consult your own CPA for individualized tax advice, but that seems like bad planning to me. So best is to plan ahead, so that way you can step up into a home. But that means you're thinking about this 2 and 3 years in advance if you're going to plan ahead and use the income that you claim. Now, the reason that that's important is because Freddie Mac and Fannie Mae, they're the ones that set the underwriting guidelines for lenders across the country. And if you follow and fit within their bucket, that's a qualified mortgage. So that's where you get the best terms and everyone's happy. If you fall outside of that qualified mortgage bucket, you can still get a loan, but it becomes what's called a non-QM loan, and those interest rates are a lot higher. So every now and then we'll have a situation where a self-employed individual comes to us, they didn't plan ahead, they don't show enough or sometimes any income, but the reality is they actually make a very good living, they just don't show it on paper. Mm-hmm. So there are things called bank statement loans for self-employed individuals. They're not for everyone. It's a very specialized product, and it has a very high interest rate. So you'll need to weigh the pros and cons of doing something like that versus planning ahead. Now, a lot of people, if they go with that bank statement loan on the front end, they'll try to use that next year or two to straighten out their finances so that they get better terms. But that assumes that rates cooperate with that strategy. And I, for one, am not a big fan of the exit strategy being a refinance. So that bit a lot of people during the last recession because they were always told you can refinance, you'll be able to refinance. Well, in theory, yes, but in reality, not always. So I don't think it's a good, prudent decision to get into a loan and shackle yourself with that kind of debt with the hope of an exit strategy being a refinance.
Why is that important that someone doesn't go in with the mindset, hey, I can have this loan for 2 years and then refinance? What could happen?
So what if property values decrease and they don't have the equity in the property to refinance? What happens if the job market tanks and their finances get worse? What happens if the underwriting guidelines change and the product you were hoping on, counting on, is no longer available? So a lot of people got really stuck holding the bag during the last recession, and they were counting on being able to refinance. And when their property values lost so much equity, they were underwater and they couldn't refinance and they couldn't sell. They were just kind of stuck. And so that's one of the major reasons why so many foreclosures happened, because people were just mailing in the keys. They couldn't refinance, they couldn't sell, and so they were just walking away in droves. So there's a lot of protections on loans these days which basically means it's a very bureaucratic process because the government wants to make sure everyone has, quote unquote, the ability to repay the loan. And so the reason that that's important, I already said it, they purely define that by your debt to income ratio. So it doesn't matter how much assets you have or how large of a down payment. If on paper your debt to income ratio exceeds what they say is allowed, you're going to have a very hard time getting a loan.
Got it. I'm sitting here thinking, man, my realtor says it's always a good time to buy and that the market's always going up. You've probably never heard that before.
Well, historically, that's true. It depends on what your holding period is, though. But it is a great time to buy. The sad part is rates are increasing with, frankly, the Fed stepping away from being so accommodative to the mortgage market. Interest rates are going back to a more normalized range, and they are expected to continue to increase. So that's going to impact affordability. It's also going to have an impact potentially on the appreciation rates around the nation. But our local market, at least in the DFW area, is still pretty healthy, and it's still anticipated to appreciate over the next few years. So what you have is a situation where rates are rising and property values are appreciating. And that means that if you are thinking to yourself, oh, I'll just save up more for a down payment, or I want to wait till I get my next raise before I pull the trigger on this, all valid thoughts. But the reality is it's unlikely you'll be able to save enough or make enough more to bridge the gap between how fast rates are rising and how much properties are appreciating. So homes are becoming more unaffordable the longer you wait. So there's a cost of waiting analysis that we can do that really helps paint that good picture for people, because they should buy sooner rather than later, in my opinion, just because of what is predicted to happen. Will that happen? I don't know. If I had a crystal ball to the future, frankly, I would be a hedge fund billionaire and not in my current role. But as it stands, all the leading economists anticipate rates to rise and property values to continue to appreciate, albeit more slowly now that interest rates are rising like they are.
Right. So a lot of people I work with, they own businesses and maybe they started the business with their own assets and leverage their own credit. And they might be wondering, how important is credit now in this equation if they're thinking about buying property?
So it's only slightly less important than your debt to income ratio. So if you don't have the debt to income ratio piece, it doesn't matter how good your credit is or what your assets are, the answer is going to be no. But assuming you have the income piece, the next most important thing is going to be the credit score, because different loan programs have different minimum credit requirements. If it's a typical Freddie or Fannie backed loan, 620 is going to be the minimum. If it's a jumbo loan, so at least in the DFW area, the county loan limit for a maximum conforming loan is $453,100, and that's for 2018. They're just about to announce the 2019 loan limits, and it's anticipated to go up a little bit. But right now, that's what the threshold is. So any dollar amount over that with the loan is going to be classified as a jumbo loan, and those have higher down payment requirements. They have higher credit score minimums, and they have lower debt-to-income ratio ceilings. So the performing loans allow you to get more leveraged with your debt-to-income ratio, whereas jumbos are more conservative because they don't have a big federal entity in the background supporting that market. They're all coming off the balance sheets of banks and Wall Street and so on and so forth.
So it seems like it would be really important to have somebody with a lot of experience in this area. If you could say something to someone who's thinking, hey, my brother-in-law just started the mortgage business, or someone asked me the other day, does it make a difference to work with somebody at a bank versus someone who works for a mortgage company? What would you say about that?
So it is a difference. So right now, frankly, banks tend to have the better price because they have, some of these big ones have trillions of dollars of assets that they don't need the secondary market for their financing. They can finance themselves with the deposits on hand. So some of their terms are fairly attractive, but their customer service, and this is just a general statement, not singling anyone out, is something to be desired. So most of the realtors that I speak with, and I speak to a lot of them, cringe at the thought of a big bank helping with the financing on a loan, on a purchase, I mean. So they prefer more local deposit institutions or independent mortgage companies. So it's important that you partner with the lender that has your best long-term interest in mind. And what I mean by that is most people aren't aware that a mortgage comes in two halves. One half is the mortgage note, which will almost always get sold to an investor like a Freddie Mac or Fannie Mae, so that we, the lender, can get our money back and turn around and lend it out to the next person. So that's the way virtually all the loans across the country are done. The exception to that is if it is a portfolio loan, that's where typically a bank will lend you money directly off their balance sheet and keep that loan on the books as an asset. So there are a limited possibility for institutions to do that because of all the capital requirement rules around banks and how much leverage they can have or exposure to the real estate market. But having a portfolio loan product like we do is a huge advantage in this market because it allows us to take advantage of certain opportunities that wouldn't otherwise exist. So that's the mortgage note side of things. The other half of a mortgage is the servicing side. And that's who you make your monthly mortgage payment to, who administers an escrow account for you for taxes and insurance, who calculates the interest you've paid year to date for the IRS, those types of things. 9 times out of 10, the servicing rights will end up getting sold, usually multiple times, until you end up with some huge conglomerate. So the lender that you choose, not only do you want to make sure they have a competitive price on the front end when you close, but you want to know what's going to happen to the loan after closing as well. So one of the main reasons why I've been at my company for so long is that we maintain the servicing rights of virtually every loan that we've ever originated. So I actually counted it up. Out of the almost 2,500 loans that I've closed and helped those families with their financing, exactly 42 of them have been sold.
Wow.
And they're almost always, the reason for it is because the investor at the time required it to be sold. So your lender should be interested in not only helping you get into debt, but also making sure that they're professionally managing it over the life of the loan. Mm-hmm. And it's harder to do that if you don't service your loans. It's one of the major reasons I'm here, and it's one of the major reasons that I do an annual mortgage review with my clients each year, just to make sure that we're professionally managing that debt, because it just does no good to just shackle you with this huge burden if we don't also stay on top of things in your financial life and partner with people like you to make sure that their retirement benefits from the mortgage and isn't impacted negatively by it. So it all has to integrate.
Yeah, I mean, that's a big difference I've noticed between working with you and other people in your industry is that you actually keep up with people, and it's not just for the purpose of selling them more stuff. It's, hey, I really, you got this loan for me. Here's what's going on. Here's some advice I might give you. Here's where the industry is going. And so you give a lot of additional advice that's not just targeted to, selling more. And most people don't even do that, frankly.
No, you're exactly right. So it's about adding value. Do I hope that they'll come back to me when the time comes for their own needs? Of course. Mm-hmm. Do I hope along the way that they'll introduce me to other families that I can treat well at a high level? Absolutely. I'm always looking to help more families, but that's not the goal. The goal is to make sure that they're taken care of for the life of their loan, because I want to be their lender for life. And there are literally tens of thousands, if not hundreds of thousands of people that do what I do, that only focus on getting people into debt and then just never, ever bother to follow up again because they don't have a relationship. And so we're not going to be the best fit for everybody, because some people, frankly, just want the absolute lowest price regardless of what the product is. And while we are absolutely competitive, and I can see where we're priced relative to our peers because we get all that data, we're not the cheapest, but we have a extremely competitive price, top-notch service, and then we have life of the loan contact after closing, which is really an unusual product offering.
Yeah, that's awesome. I love how you take care of clients. It's aspirational for sure.
Well, thank you. It wasn't always this way. You definitely grow in your career as you get more tenured. So progress, not perfection, is the motto.
Right, of course. My dog is playing with that house-shaped chew toy that you gave me. He really enjoys it.
Yeah, well, actually, that's funny. I have a little flyer that goes along with that I'll give to families moving with pets to kind of help with the stressful transition for the pets as
Yeah,
well, because it's not just the humans that are moving, the pets are too.
that's true. And they're stressed out. It's a new place. That's really thoughtful. We should do a separate episode between you and Jordan Gill. We could do a really great episode on processes around like strategic gift giving to clients. I think that'd be really interesting.
Yeah, absolutely.
So this is the tell us a story portion of the event. So you can tell any story you want, client success story, funny story, personal story. We've gotten lots of different responses. So now it's up to you to give us the story.
Yeah, well, the story I'll tell, it'll be a professional one. I don't know that some of my Mardi Gras stories from back home in New Orleans would be appropriate for the podcast, but
I have my fingers crossed.
yeah. So some of the things that we help the families with, we're very big into the veteran community, frankly. My partner, Felisa, she's been with me for years. She's an Air Force veteran. And then one of the things I'm very, very proud of is how flexible we are with our VA loan underwriting. We do keep the veteran their best interest at heart. We have helped lots of veterans over the years that have been turned down by other companies. A lot of people think if one company can do it, another one can as well. That should be the case, but that is not always the case. VA loans are very, very specialized, and we have a fantastic heroes discount that we give to our community heroes. Veterans, of course, are in that category, but it's not just veterans. It can be police, firefighters, teachers, doctors, nurses, clergy, coaches. It's a broad category of community heroes, and it's a $1,500 credit that goes to wipe out the big chunk of the cost associated with this. So it's a really significant deal. Most people hear that, have said, oh, other lenders do that as well. And you would be correct, except that the way most lenders pay for that is they increase the interest rate as a result. So yeah, they're giving you a credit, but the terms that they offer you, the rate for the life of the loan is higher because they do that. I'm very proud of my company because they have set this up to where the terms are exactly the same, regardless of whether you're a hero or not. So the interest rate is not any different if you take advantage of our heroes incentive, but it's a $1,000 credit that comes from my company and a $500 credit that comes from me personally on these loans. And it's a very easy way for us to say thank you to our community heroes. And I share that long-winded story with veterans specifically. Nothing brings me more joy than helping a veteran that was already turned down by another lender and helping them achieve their dreams and goals of home ownership and treating them very, very well along the way. So I had a situation where this couple, they were locked in with another, we'll leave it unnamed lender, and the rate they were quoted at the time was 5.625%. Our rate sheet rate for a normal VA loan was 5%, and once we applied the Heroes discount to buy down the rate, we ended up at 4.75%. So that's just the note rate. That's the APR would be different, of course, but it was almost a full percent difference. And unlike them, who denied the veteran deeper into the process, we were able to get them essentially a significantly better rate and close, I think it was 3 days after their original close date, and they were thrilled. So those types of things, those types of stories where we help clean up other lenders' messes, those are the ones that bring me the most joy. They're very stressful, but those are the big wins that I'm proudest of.
Yeah. So if somebody's thinking about reaching out to you, how early in their process should they reach out to you when they're thinking about buying a house? And then what are the ways that they should reach out?
Great question. So the honest answer is it's never too early to have a conversation. Don't think that just because you call a lender that they're going to immediately want to pull your credit and do those types of things. We really just need to have a high-level conversation about what your goals are, what you're trying to accomplish, because we need to make sure to fit the mortgage within your long and short-term financial goals. So the best way to do that, if you're self-employed, I would say let's start having a conversation as early as possible. 6 months to a year or longer would be ideal. If you're not self-employed, just a normal salaried individual, God, really 3 to 6 months is plenty of time. Every now and then, though, we have people that will just go out and write an offer on a property without having any due diligence done. Sometimes it works out, sometimes it doesn't. I would encourage you to not be one of those people, though. Get your ducks in a row ahead of time. It does take some time, so despite what television ads might say, it's not as easy as clicking a button online. There are documents that have to be reviewed. It is a multiple day process. So don't call at 4:30 on a Friday saying, I need a letter by 5. That's just not how it works. So we need to plan ahead. We need to get our ducks in a row. If you're going to call, the phone number for my team is 469-906-2522. Again, 469-906-2522. You can text me at that number as well. If you're going to email us, it's thebetz@gmc-inc.com. And then if you want to get really fancy, you can go to schedulewithwade.com and select one of the options there to book an appointment directly on my calendar. Whether that's a phone call or a face-to-face, that would show you all my availability for the next 2 months. And you can just pick something that works for you, and that way we can make sure to coordinate and knock out whatever we need to discuss.
Awesome. Well, thank you so much for your time. This has been Wade Betz with Guardian Mortgage. We appreciate it.
Thank you so much. I appreciate y'all. And if y'all need anything, don't hesitate to hit me up.
Thanks for hanging out with us, and I appreciate you listening to this episode. I would love to get some great feedback from you. Feel free to leave me a 5-star review on whatever podcast platform you're listening to this on. Also, any ideas or want to follow up on anything that happened in this episode, I would love to receive your emails. You can email me at kristen@ashtoncharles.co. Otherwise, I hope this episode has helped you be great in your business.